debt is one of the most important parts of your deal because, in my opinion, it's the largest source of risk. So you could buy a property at a great price and you can have a great business plan, but if you finance it incorrectly, you may be setting yourself up for a downside scenario that you are not willing to accept. And so you need to understand the implications of the debt that you're using and the risk factors of debt, which are the interest rate, the leverage, and the maturity or the length of the debt. And those are fairly simple points, but they all have a role in determining how much risk you're taking with your debt. And more debt or less debt is not necessarily always the right answer. Again, it depends on the deal. It depends on the investment goals. And that's why it takes a little bit of nuance and understanding to figure out, okay, this is the right amount of leverage because this is the sweet spot where we can still get better returns through enhanced returns through the debt, but yet we're not putting ourselves into a certain risk territory that we're not comfortable with. So that is, the first thing. There's a lot of variation on debt as far as fixed rate versus floating rate, short-term debt versus long-term debt, recourse versus non-recourse, and other bells and whistles that you're going to want to be aware of as you go into your deal. And this is true whether you're on the passive side or the active side. Certainly you'd hope that you'd have a good understanding of this. You want to be familiar at least with these concepts, so that way when you're presented with a deal opportunity, you know what you're getting into. You don't want to be surprised.